Hi, and welcome to another edition of Ask Spurrell CPA. Today we're talking about general and overhead expenses. I have Cole with me here again today. Cole, thanks for coming. Are you excited for another tax time?
Yeah, starting to get excited. It's picking up here, so.
Hey, that's like our playoffs, right? We got to be ready. So, Michael Gerber has a good quote on this subject, author of the E-Myth. The fatal assumption is if you understand the technical work of a business, is that you understand the business that does that technical work. And let's look at a statistic when it comes to business owners understanding general and overhead expenses. You know, the makers of QuickBooks, Intuit, they did a survey, a financial literacy survey for business owners. And the questions that they asked them were basic financial literacy questions, you know, the roll of the balance sheet, accruals, cash flow questions. And they found that 82% of the respondents got a score of 70% or less on these basic business financial literacy questions. So, and then it flows into our story here is we have business owners and they don't really understand how much they need to cover their overhead, or certainly how much revenue they need to generate to cover their overhead. And often they just don't understand, you know, how much they need to make in order to keep the lights on, so to speak. So, Colt, what are the questions you think these business owners should be asking when it comes to general and overhead expenses?
Well, the first one would be, what are general and overhead expenses?
So general and overhead expenses are the expenses that are not direct costs of sales. So the general and overhead expenses, you know, they're not the direct costs of the supplies, the contractors who only come out and work because there's revenue. If you're a physician, it's that associate physician. They're a direct cost of sales. You know, you pay them 60 or 70 or 40% of revenue. Those are direct expenses. But the general expenses, that's everything else in the business. So the expenses that are not directly related to the generation of the revenue, they're not directly tied, and they generally don't vary as directly as the other overhead expenses.
What are examples of direct costs not included in overhead and general expenses?
So the direct costs, again, those direct costs are really, we're talking about, you know, the contractors, the supplies that are, and the direct cost of labor generally. Those are the three things that are in the direct costs. So we're looking at the cost of supplies, the contractors, and any self-performed work, the direct labor costs. Those are generally it. I mean, that whether we're a contractor or medical professional, the same thing. So we have a associate doctor who gets a percentage of revenue, or if we're a construction guy, we got a subcontractor. That directly relates to the project. Whereas the overhead expenses, you know, there are things like the rent and the administration staff and the costs for the office supplies, and these things don't directly relate to the revenue itself.
Okay. Why do you recommend sorting your expenses in numerically descending order?
Yeah, so you're starting, you can imagine your income statement, we have revenue at the top and we have direct cost of sales, and after that we have our gross margin. And then we start getting into the general and overhead expenses, and I recommend always sorting these general and overhead expenses in numerically descending order. So the biggest at the top and the smallest at the bottom, and that would be different than people who recommend, you know, sorting it alphabetically. And I guess I understand that alphabetically for an organization point of view, but really I like to sort them in numerically descending order because we want the most significant items at top. You know, we're not generally going to make a big difference in the business if we're able to, you know, change the interest and bank charges or the, or small office supplies. That's not really going to make the big difference in the business. But it's the big items, you know, right at the top. Those are the ones we want to spend our time at. So we rank expenses in numerically descending order. And as a business owner, you know, you're almost, you know, drawing a line, and it's the things above the midpoint. If we can spend our time on to make a difference on, they're going to make a bigger difference on the net income at the bottom.
Where do admin wages and rent normally rank in overhead expenses?
So normally when we're looking at the general and overhead expenses of most organizations, the admin wages and the rent, or the cost of the space, the interest on long-term debt maybe, these are the most significant items. So we're looking at the order of significance in numerically descending order. So normally we're going to see the administrative wages and the rent, the cost of the space that business is in. They're normally 1 and 2 in most businesses. And these are the things that, are really making a difference in terms of the profitability. So they're normally at the top of the list. And if we want to make a difference as a business owner, are we in the right space? Do we have the right amount of administration staff? So this is the staff that's not directly related on a billable project, a revenue generating project, if you will. How much does that cost us?
Compared to direct costs, can it be more difficult to reduce overhead costs?
Yeah, it really can be more difficult to reduce the overhead expenses because a lot of the overhead expenses, they're almost fixed in nature. We have a rent, and say we're locked into rent at $4,000 a month. It's not like a material where we can source out a cheaper material. It's either we're in that space or we're not in that space, and often we're locked into a lease for a extended period of time in that space. And it's the same thing with the administrative staff. We have a staff, and often the decision is, do we keep the staff or do we lay off the staff? That's often the choice, because sometimes going to a staff and say, hey, I'm going to roll back your wages 3% or 5%, it doesn't go over that well, right? And same with cutting hours. Sometimes there's the opportunity, and sometimes that is the move, but it's more difficult. It's a more difficult conversation, and sometimes it's an impossible conversation. So changing those overhead and variable costs can be difficult. Often it's either keeping or eliminating the line item.
Why do you normally expect interest and bank charges to increase with revenue?
So these are the one, that's one example of the overhead expense that'll vary with the revenue. A lot of people in most businesses are collecting some or all of their fees from credit card and debit card machines. And especially on the credit card, we're expecting 2 to 3% on a charge from the credit card processor to ring it through. So if you see interest and bank charges jump up, well, that might actually be a good thing, because that means we sold more money. We sold more items this month, so it costs us more money to process the transactions. So generally, in most businesses, because we're relying on credit card machines to process, and we get a fee every time we bring $1 through. If we bring more dollars in, we can expect those interest and bank charges to go up if revenue is going up.
Does knowing your overhead expenses help you understand your break-even point?
Yeah, so it is extremely important in understanding that. So the exercise of separating those direct costs of sales and those overhead costs of sales. These overhead costs of sales are almost like these are the expenses that are going to occur, whether we do any revenue or not. We're going to have to pay the administrator and the receptionist in the office. We're going to have to pay the rent. We have a certain amount of office supplies that we're using every month. We have to pay our insurance premium every month. We might probably have a couple of licenses and dues that happen every month. Software dues, things like that. They're almost like the fixed costs of the business. And so if we understand what those fixed costs are, we can now work backwards. And let's say we have a business and it has $20,000 worth of overhead expenses every month. And then we end up having that, let's say this business has a 25% margin for every $4 that it brings in revenue, it gets to keep $1 after it pays the contractors and the supplies and the direct costs of the labor. So every $4 it brings in, it's $1. And so then we have this business that has $20,000 in overhead expenses. And if we know that the margin on the product or service that it's selling is 25%, so every $4 coming in, there's $1 left over after paying the direct cost. Now we know we can take that overhead expense, multiply it by that 4, and this business needs to bring in $80,000 of revenue each and every month to keep the lights on, to break even. That becomes the break even point, so we can work backwards. If we know the total of the overhead expenses each and every month, or a rough estimate of the total, and we know the margin on the products, we can take that overhead expense and either times by the multiple or divide by the percentage of the profit margin, and we get our break-even point in terms of revenue, which is an extremely powerful number. And a lot of business owners, they don't understand it, and a lot of times they think that I can add another $5,000 to my overhead, and I got to sell another 5,000. It's like, no, you have to sell. You can't just add, another, bring on another staff member and sell another $5,000, because if you sell $5,000, you have the materials and the contractors and the direct cost of labor. You're not going to keep that $5,000. So we have to keep in mind that bringing on overhead expenses, for every dollar we bring on in overhead expenses, in most businesses, we're talking about bringing on an extra $4, $5, $6 in revenue to pay for that overhead expense.
When your income is breaking even, could you still have a negative cash flow? Yeah,
you can. So we got to be careful when we talk about break even, because that's break even from an income level. So we get to that same business example and they have $80,000 worth of revenue, and they have a 25% margin, and they make $20,000 gross margin off of that, and then they have a $20,000 overhead expense, and we're going to have the income from operations at zero. But they could also have a loan payment. So they have income from operations at zero, so the revenue and the expenses are totaling zero, but then we have repayment of the principal portion of a loan, which could put them into a negative cash flow situation. So often, there's repayments of debt or payments to shareholders that can make that break-even point. It's still going to be negative cash flow at that point.
How can admin staff on revenue-producing activities sometimes best?
Yeah, so I guess if you have a hard choice and you have this overhead and it's too high, and a lot of times we're looking at, we're sorting that income statement in numerically descending order. So we're looking at what can we actually do. We got to get this back in line, and we're starting to look at rent. Can we get out of rent? Usually we're locked into a lease. That's a long-term goal. Usually to get out of rent or downsize that rent or do something there, or bring in enough revenue to cover that rent. But in the interim, a lot of times what can be done is we talk about can you lay off a staff member? Can you roll back some wages? Can you cut their hours? Those are all real difficult things to do, but sometimes you can just retask that staff member onto the billable side. So what is that billable side of the business? Can we get them producing revenue generating activities? Then we don't have to lay them off. We don't have to roll back wages. We don't have to slash hours. But if we can just get them on the revenue producing activities, it might be a stretch for them, and it might be a little more difficult for them. But sometimes when it's positioned as, hey, you're a valued member of this team, and we'd like to keep you on, but we can't keep you on an overhead capacity. We have to make sure it's a revenue generating capacity. Sometimes that goes over a lot better than the proverbial pink slip. So
what does it mean to say you have a revenue problem, not an expense problem?
Yeah, so there can be the doom loop of business owners, and they have these general expenses, and they somehow think that if they slash and slash and slash and slash, that somehow they're going to get to this magical point where they make money. When you start looking at that margins of the businesses, all together, and it doesn't even seem plausible that they could, if they slash all of their overhead expenses in half, can you imagine, I'm going to pay half of my phone bill and half of my utility bill and half of an administrator and half of my lease, but they have this, slash and burn mentality that if they can get there, they'll suddenly make money. But even if they were able to accomplish that, the business is still not viable. It is a revenue problem. They just simply need to do twice as much revenue in order to get this thing rolling. So sometimes you really have to look at that, and is my time really trying to incrementally move down those general and overhead expenses, or do I need to be taking massive action in order to boost that top line revenue, or maybe change the margins, the profit margins on the revenue that I'm doing? So a lot of times it's a revenue problem or it's a margin problem, not an overhead expense item. Most of the overhead expenses, they're not going to make the difference whether you win or lose. They might make the difference by how much you win or how badly you lose, but they're probably not the difference between winning and losing. They're just a couple of extra percentage points on the inevitable outcome. So I think that's what we have here on this subject. Thanks so much again for tuning in, and we look forward to Bringing you another episode of Ask Spurrell CPA. Please hit the like and subscribe button so we can continue to deliver you tips to help you beat the odds of business. Thanks very much.
Thanks, guys.